Okay, ready? Start. They say a week is a long time in politics. It is true for the global economy too. Harold Wilson's equipped during the sterling crisis of 1964 resonated across UK and global financial markets this week. The sterling pound bar cable cost $2.80 in 1964. This week, His Majesty's pound was well pounded down to $1.03 by King Dollar. Context matters for policy, particularly when regimes lean on history to reincarnate economic growth. In 1942, John Maynard Keynes observed, anything we can actually do, we can afford. We are immeasurably richer than our predecessors. Britain was rich. In 2022, its GDP ranks below India and its economy depends on what Mark Carney described as the kindness of strangers. Keynes was advocating the engineering of policy to create public goods, not private enrichment. The policies unveiled by the Liz Truss government validated what Rishi Sunak dubbed fairy tale economics and triggered a rebuke from the IMF, a ratings review by S&P, and panic in the markets. The turmoil, slow liquidity evaporate, forcing three large economies to intervene. In the UK, a meltdown in the pension funds following a crash in the value of bonds forced the Bank of England to fork out £65 billion. Earlier, the Bank of Japan intervened to halt the precipitous slide of the Japanese yen past 145 per dollar. In China, the People's Bank of China stepped in and warned markets not to gamble on one-way depreciation as the yuan plunged to 7.2 per dollar. In the United States, yields on the benchmark 10-year paper nudged past 4%, triggering fears in emerging markets. A stronger dollar has impacted earnings of listed multinations. Equity indices in the US recorded the third successive quarter of declines. The benchmark S&P, Nasdaq 100 and Dow Jones are down 21% this calendar year. The crux of the carnage is the persistence of inflation. The burden of easy money printed in developed economies during the pandemic is roasting economies across the globe, even as central banks struggle to contain inflation. Aggravation arrived in the form of over $500 billion in consumer protection inducted by governments in Europe and the UK this week. Germany cleared a €200 billion package. In August 1975, Milton Friedman published the seminal tome, "There is no such thing as a free lunch." A year later, in 1976, Margaret Thatcher famously said, "Socialist governments always run out of other people's money. The lessons have come home to haunt." Ironically, in 2022, Britain is running out of money under a Tory regime. By definition, inflation is too much money chasing too few goods. It is true that earlier supply chain disruption, higher energy prices, and food scarcity impacted inflation. That, though, is no longer the case. Supply shortages have eased. Companies like Nike are wrestling with higher inventories. Energy prices are down with crude oil in the mid-80s. Energy prices are down with oil in mid-80s. The villain now in the popular commentary is the tight labor market. The US Federal Reserve is trying to lower inflation by pushing unemployment higher. What is not being debated is the workforce gap and demographic challenge faced by the US, Europe, and post-Brexit Britain. Wage costs also depend on demand and supply. A study by Giovanni Perry and Reem Sawyer at the University of California, Davis shows that by the end of 2021, there were about 22 million fewer working age immigrants in the US than there would have been if the immigration trend had continued unchanged. The front loading of steep interest rate hikes to curb demand and engineer unemployment to tamp down inflation comes with risk. Since March, the US Federal Reserve has hiked interest rates from 0.25 to 3.25% and aims to touch 4.5%. To appreciate the pace of hikes, one must consult history. The last rate hike cycle stretched from 0.25% in December 2015 to 2.5% in December 2018. In effect, the US Fed has hiked rates higher in 6 months of 2022 than it did in 3 years. Yet inflation continues to rage. It is now feared that the systematic shock to financial stability witnessed in Britain could knock on the doors of developed and vulnerable markets. Stops.